It is noon here in Fort Atkinson, where we are based, so we will get started with this month's webinar. Hello to all the listeners who are out there, and Happy New Year to you all. I'd like to welcome you to our first monthly webinar of the year. My name is Abby Bauer, and I'm an associate editor for Hoard's Dairyman magazine. Thank you for joining us today for this webinar, which is titled Pandemic, Prices, and PPDs, What Will 2021 Offer? Our presenter is Mark Stephenson from the University of Wisconsin-Madison. In the sometimes complicated and always changing world of milk prices and forecasting, Dr. Stephenson has a great way of explaining the current dairy situation in a way that we can all easily digest. So we're eager to hear what he has to say lies ahead for all of us in the dairy industry here in 2021. Our sponsor for today's webinar is Cargill, and we certainly appreciate their financial support of this program. My co-host for today is Mike Hutchins, a professor emeritus from the University of Illinois. Also working with us today are our online webinar producer, Jim Baltz, and our Hoard's Dairyman online media manager, Patty Hirchin. It was 10 years ago this month that we held our first Hoard's Dairyman webinar with Mike and our former managing editor, Steve Larson, teaming up as the host. Over the years, we've had dozens of presenters and a growing audience, and we are thankful for that. All of our past webinars can be viewed on our archive, which is available online at www.hoards.com. If you're listening to the presentation live, you have access to a PDF of the handout of the slides, which you can print off as a handout in case you want to keep that for future reference or to take notes on. You can find that in the GoToWebinar control panel down near the bottom in the handout section. Also, if you have any questions for Dr. Stephenson, please type them into the questions section of the GoTo control panel, and we will answer those at the end of the presentation. At this time, Mike, could you please introduce Dr. Stephenson, and we will then begin his presentation.
Well, thank you very much, Abby, and it's my personal privilege and pleasure to introduce Dr. Mark Stephenson. Mark grew up in Michigan and got his undergraduate training at Michigan State University and a master's degree, and then he ended up getting his PhD at Cornell. And he spent a number of years in the field before joining the staff at Wisconsin, where he is Director of Dairy Policy Analysis at the University of Wisconsin-Madison there. And therefore, he coordinates the research and outreach activities related to the dairy industry. Mark is on a number of different webinars and opportunities here, and I've had the pleasure to share the podium with him several times. So, Mark, we're very pleased to have you on board today, and I'll turn the program over to you and let you begin your webinar today. Thank you.
Boy, thanks, Mike, and I'm happy to be here with you today. And I got to tell you, more than most years, I think that forecasting is a heroic thing to do, but I'm going to take a shot at it because you asked me to. So maybe there are some things that I can suggest that are maybe going to provide some at least bumpers on either side of cash forecast for milk prices in the year ahead. And the slide that I want to look at is to begin with here is whether or not 2020 is really in the rearview mirror. Well, we know that the calendar is, I mean, pretty clearly, but you can see that the cow's still got the mask on, and we want to know what 2021 will offer. So let's start off there and recognize that we aren't quite done with COVID yet. Unfortunately, we're at another peak. And you can see by this chart that we really didn't start seeing very much at all in the way of COVID until the very end of February. And our first wave of COVID really hit during that mid-March and April time period. We troughed a little bit then in May. We built to a second wave in July, troughed again over the late summer and early fall. And boy, you know, we're hitting new peaks in this third wave of U.S. daily infections where, you know, we've been up around even close to 300,000 new infections daily. So COVID is hitting us in waves, and it is capturing the attention of all kinds of people, and it's been providing pretty heavy impacts in the marketplace for us. Back at the early part of March, April, May, when we were struggling with what do we do and how do we treat this, we had supply chains of all sorts that got disrupted during that time period. We've learned a little better how to live with it since that time, but we still are not done with COVID at this point. The markets have done a remarkable job, though, of moving milk. You might remember initially when we were all safer at home in that April and early May time period, we had shocks to the marketplace. If we just take a look at cheese, historically about half of that cheese is consumed in out-of-home eating. So to have restaurants shut down is a big deal. And even if you look within the cheese category, there's some real differences out there. The vast majority of American processed cheese, those are those yellow singles that get put on a hamburger to make them a cheeseburger in fast food restaurants, or it may be the semi-plastic cheese that gets pumped on your plate of nachos. That's all food service. And so in the first several weeks that we were safer at home, it depended on what your marketing chain was. An American processed cheese plant might have essentially completely lost their customer base at first, whereas pizza sales were largely takeout or home delivery anyway, and those pizza sales have surged. We've had a lot of cheese product moving through that kind of channel. We've also had new channels open up, like the farm-to-family Foodbox. That's had a big impact on our dairy markets. We've had 4 waves of that, or sessions of the farm-to-family Foodbox. We have a 5th one that's been announced, and we'll be buying dairy product to help fill that. And so all of these things have been different, but they've continued to help us move dairy product. If you look at the total category of cheese consumption has been way up at retail and down at food service and institutional establishments like schools. But if you look at it in total, the total commercial use is actually down less than half of 1%, but it was expected to be down a lot more than that. And we were very much concerned in the early part of this pandemic. That's when we had headline grabbing news of milk being dumped and a variety of other things because the market simply couldn't handle the loss of sales through those restaurant channels. But cheese has done pretty well. Let's take a look at this commercial disappearance of cheese. This is on a monthly basis. You know, we often would talk about what's the demand for cheese. That's a number that is really pretty hard to come up with, but we can look at a variety of things like how much cheese was actually made in a given month. We know those numbers. What was the change in beginning of the month stocks versus end of the month stocks? How much was exported? And we figured that everything else was probably sold through commercial disappearance. And that's what this is showing us. I would point out right there, that number, that trough, that slot in the graph, if you will, was our safer at home. So commercial disappearance of cheese fell off dramatically for a short period of time. And yet we had quite a bit of cheese that was still being made by cheesemakers who didn't know if they had a customer for those products at the time. So we continued to move milk, but it was not going through commercial channels. It was showing up as change in stocks in the short run. Other categories of milk, though, have behaved somewhat differently. This is average daily sales of fluid milk. And you'll notice here that since 2010, this is a story that all of us probably are well aware of. We've had a pretty dramatic drop-off of fluid milk sales in this country. But down here toward the end of it, we've had actually an uptick in 2020. Our Safer at Home has given us a few different things. About 2/3 of the milk is normally consumed at home anyway. And since we were safer at home, sales were up. We had empty store shelves or stockouts that were reported pretty early on. But retailers and fluid milk bottlers reconfigured. They narrowed the number of product offerings on the dairy shelves, maybe to their higher sales volumes, like gallons and half gallons of whole milk and 2%. And they dropped some of the SKUs, the stock keeping units of the products that weren't moving as rapidly. And we've had total increased sales. So that's been a good thing at the tail end. If you look at some of our other categories, let's focus just a moment on butter. More than half of butter is used in out-of-home eating. Of course, at high-end restaurants, butter has been used for a very long period of time, and higher fat dairy products in general. But food service and institutional uses of butter have been substantial. Even chains like McDonald's have begun using a lot more butter. But even though we had been safer at home, the butter sales through retail have been almost off the charts. And pandemic cooking is a real thing. If you look at the total commercial disappearance of butter, it's almost the same as what it was last year, down 0.2% for the year to date. So our sales of butter have held up really quite well through the pandemic. Let's take a look at the production of milk during this time period. I'm showing you the last 3 years, 2017, 18, and 19 in the gray lines, and the red line is 2020. We started off the year with a pretty big surge in milk production. It was big in no small part because the fourth quarter of 2019 were pretty good milk prices and a signal to dairy farmers that the market could take and was expecting to use more milk. But then, of course, by the time we got into the early part of March and April, COVID hit, and by the time we got into May, we had to have base excess plans being implemented by cooperatives. And even if you sold milk to proprietary plants, your plant was probably telling you to slow down. And slow down we did. You see the dip in May. That was base excess plans being implemented. But after that, we had quite a turnaround in demand, and even plants asking for more milk, and milk production's come back online. Officially, I would say the last 3 milk production reports of September, October, and November are big increases. November was up 3% from year ago levels. So milk production has been a bumpy journey this year for sure. I wanted to ask a question though, and that is that if we have more milk than the markets can handle, because 3% is a lot of milk, if we were asked to face a base excess plan again, how are you going to meet it? What is the strategy that you would use, maybe compared to the strategy that was used last time around?
Okay, Mark, I think we're pretty well off and running where the voting has started, and they're coming in as well. You have 5 choices. 1, cull cows. 2, we can reduce the intensity. We're just going to cut back on feeding most of the cows. Number 3, dry cows off earlier. Or a combination of those 3 choices would be your 4th choice. Or the last choice is I'm not going to do anything at this point. So the votes are coming in, and we got about 50% of the vote in. Annie, do you want to? Where do you think we're going to end up here?
Yeah, I mean, I think, we have our Hordes Dairyman farm. We haven't had to reduce production there. If I was a dairy producer making decisions, I'd probably go towards that dry cows off early, still hang on to those cows in hopes that, the ability to produce more milk was in the near future. But I know people have had to do many different strategies and different times over this past year. So we'll see what people in the audience respond.
Well, Jim, we've got 60% of the vote in, so let's go ahead and post the answer. And Mark, what do you think of your survey answers? Any big surprises there?
I'm a little surprised. Not that, the 2 big responses, ignoring the combination of the above, was cull cows, and I don't intend to change my milk production. I think we saw some of both of those things in the last base excess plan, but really, quite literally, most folks are saying, more than half, that we were going to do some combination of the above, which is dry cows off early, cull cows, and reduce the intensity of the ration. Dry cows off early was by far the least popular. So that is an interesting thing to me, and I think that it's one of those that we'll want to be sure that we are watching, because it will make a difference if we get into that. So let's go back now and take a look at some of the concerns we may have. The pandemic prices, quite honestly, have not been nearly as bad as we expected. My goodness, when we were in April, the current prices that we had in that month and the forecast for prices for subsequent months on futures markets were pretty poor. Since that time period, we've actually had incredible changes. Milk powders have been performing the service of clearing the market of the XX stocks out here, but butter stocks, even though they've been drawn down seasonally, have still been fairly good size and growing. We've been thankful for those food boxes. They have really put a demand for fresh cheese on the marketplace, and they have swept out the fresh inventory that was there. The inventories after April, when we first were closing down, had a lot of milk on the market, weren't moving as much product. Our cold storage numbers showed inventory swelling for about a month period of time, but the food boxes swept a lot of that inventory out, and they're not particularly burdensome. But what a ride, my word. $1 a pound cheddar cheese prices in April. We hadn't seen that since 2006, I believe. And that caused real interest from export markets that this was well below so-called world prices or competitors for those cheese markets. And we sold quite a bit of cheese in a short burst. But 6 weeks later, we hit new all-time highs for cheese prices on the spot markets, $3 a pound. And those sales were done immediately because they were now well above those world market prices. We now also have to recognize that we are seeing ourselves going into a tailspin of worldwide recession, not just here in the US, but virtually everywhere, because the virus has induced all kinds of supply chain disruptions. And I don't mean just for dairy. Even big corporations like Apple put off the introduction of new iPhone series because they couldn't get all the parts needed to assemble them in one place. It's been a big disruption in virtually every single supply chain across the globe. And our markets are very much intertwined. But, you know, we have some different kinds of markets going on at this point in time. And I wanted to point this out. This is looking at the unemployment rate. Now, it's typical for us to be around that 4% range, you know, of unemployment. That's when we feel like an economy is doing okay and moving along. We were horrified, frankly, in our last recession when our unemployment rate climbed to a high of 10%. And you'll see that that took basically through 2008 and 2009 before we got there. And we have frankly spent from 2010 until 2020 working that number down. Now, we got down to something below 4% unemployment. That is full employment for sure for the US, but look how rapidly that spike went to nearly 15%, higher than the unemployment was in the Great Recession. It's been shorter. We've made quite a comeback from that place, but we're still seeing pretty high unemployment rates, and I don't think that we're going to have that drawn down for a long period of time. Our Great Recession was at that point, and now let's take a look at a couple of other things. This is looking at a restaurant performance index, and this is a series of questions that are asked of restaurant chains, everything from fast food through fine dining, and they compare the answers to year earlier levels. These are hard questions. These aren't opinion questions. These are, how many customers did you have? How many employees did you have in your restaurant? Are consumers buying at the higher end of your menu or the lower end of your menu? And based on those answers, you get this restaurant performance index. This is shaded different colors. The green area above that level of 100 is meant to show an expansionary range for restaurants, below that contractionary. Here you can see that time period of the Great Recession. Restaurants took a hit. In fact, we hadn't had a restaurant performance index that low prior to that Great Recession time period. But we've climbed back out of that. We had restaurants that were enjoying growth again until we got clear over to the right-hand side when we've seen this pandemic-induced recession. And notice here that since restaurants were ordered to close and not able to do much of anything except sell curbside and later, at much reduced staff, or not staffing, but customer rates, like maybe 50% of occupancy or 25%, depending on the state and the time. Our restaurant index is well below where we were at the bottom of the Great Recession. So restaurant segments have been hit hard. I didn't put other segments up here like the entertainment industry or the travel industry. Those have really also been hit very hard. So this is specifically the restaurant segment. This is another survey, and this is a survey of consumers' confidence in the economy. Here, this is an opinion question. Consumers are randomly called every month. They're asked simple questions like, what do you think about the economy today? Is it good, bad, or otherwise? What do you think about the economy in the near future, the next few months? And you can see that the consumer confidence index for the Great Recession also plummeted well down and hit that level nearly at 25, which was an all-time low for this consumer confidence index. We climbed back from that, but you can see clear over on the right-hand side what consumers were thinking about the economy right now as far as that goes. This was not at a level below the bottom of the Great Recession like the restaurant chain index has been. So this is telling you that consumers are concerned about the economy, but not as badly as they were in the Great Recession, whereas restaurant segment of the industry is much worse shape than it was during the last recession. So this has been different. And I tell you that this is a different recession because in 2008 and 9, that was all about decline in asset values. We worried about housing values collapsing, mortgages getting upside down. Stock market plunged quite a bit during that time period. That had a greater impact on people more on the wealthy end of the spectrum of our society. This pandemic recession has been much more about job loss. And this has impacted people in the service sector much more and kind of at the other end of that wealth scale. So it's hitting different people than our last recession did. It will have an impact on dairy demand if people remain out of work and if we really can't get back into the restaurant segment in a serious and strong, meaningful way. This consumption-based economy is really at the foundation now of our U.S. economy. 71% of our gross domestic product, our GDP, is developed as a result of consumption. Whereas a country like China, for example, consumption is a relatively smaller part of that GDP growth. They get much more GDP from investment, from building out infrastructure and that type of thing. This is not the kind of comment where you say one is right and the other is wrong. It's not. It's just different. But it has a different impact when consumption is hit hard, as we've seen in this recession. This dairy trade is something I did want to draw your attention to. The blue line going up and measured off of the left-hand axis is the percentage of our milk production in the U.S. that is exported, the percent of solids in milk production that's exported. On the right-hand axis and in the green line is the U.S. all milk price. A lot of volatility in that all milk price. And in the blue line where we've got the exports, you'll notice that there's some up and downs in there too, but it's mostly been trending upward until recently. The few places where we see that export line plateauing or dropping I've tried to highlight with the yellow bars in the background there just to show you that that corresponds with time periods when we have a pretty big drop in our U.S. all milk price. If we're geared up toward more exports, and for whatever reason, whether supply chains are disrupted because of a pandemic, or you have a worldwide recession like we did in 2008 and 9, and countries can't buy as much dairy product, if the product stays home here on our shores, you'll notice that our U.S. all milk price plunges. And that's kind of where we've been and what we're still involved in now. Dairy trade's important to the U.S. dairy market at this point in time. You might remember that near the beginning of this, when I was talking about quite a lot of butter sales through retail, I did also mention that stocks had gone up. We've cleared our market with powder, but that's also left quite a bit of cream that's either going to be churned or used some other way. We've used a lot of it in other ways through retail, but a lot of it got made into butter. And you'll notice the 3 previous years, 2017, 18, and 19 in the gray lines, that there's a seasonal pattern to this, and it tends to be fairly tight. The red line of 2020 is showing you that our stocks have been quite a bit higher than world market, or than we normally are. And part of that's because we haven't been able to sell as much into world markets as we might like to, but that's perhaps about to change. This slide here is showing you in the red line the US price per pound of butter, and in the green line it's showing you a competitor for those world market prices. That's the European Union, and the blue line are the Oceania prices, all in US dollars per pound of butter. If you go clear out there on the right hand side, you'll now see that the US value, the last one I have reported, was at about $1.44 a pound and is below the prices for the EU and for Oceania. So I think that we have some opportunities to begin selling butter very shortly, and we may move that enough to pull down our butter supplies a little bit. So I think our butter prices, while we'd like to have them up higher for milk checks, is at least at a place where we're likely to start selling and exporting more butter. Cheese prices for the US have been off the charts, both way below, and you notice here in 2019, in this region here, when we had our plunge in prices that took the CME prices down to $1 a pound, it was way below competitors of Oceania. Since that time period, we hit $3 a pound at the CME, far above our competitors. But those cheese prices have also been coming down. And, you know, with maybe slight discounting, we're at a place where we can begin to sell some more of that cheese into world markets at our current prices. So those prices are set to, I think, also be supportive of exports. Powder prices, we're almost always competitive. And here the red line for the US is showing you that we're well under the EU, Oceania, and even South America. We export more than half of the powder that's made in this country. We have to export that product. It's got to be price competitive all the time. And it's one of the reasons that our class 4 prices have been below our class 3 prices when we have cheese that can, for at least short periods of time, soar on their own in just a domestic market situation. I want to just take a quick look at our percent change in milk production. I showed you the absolute milk production graph earlier, but this range of about 1 to 2% increases is a pretty comfortable range for the US to be in. In this range, we can satisfy growth in our domestic consumption of dairy products, and we almost always are growing domestically, and we have a little bit more growth for exports. When we get above 2%, now we're in the big growth territory, and that almost assuredly has to be handled through export sales, and we're counting on that. As I pointed out earlier, we're at 3% growth in November of milk production. That's big milk production growth. We don't get above that level very often, And so we've got to move a lot of product. Now, how are we doing this? Dairy cows are one way. When I asked that question about if you were to face a base excess plan again, what would you do? One of the primary answers was cull cows, and that is indeed one of the things we did. You'll notice from March until June, our dairy cow numbers were drawn down, but after that, they've been building back up again. This is adding capacity to produce milk in our U.S. dairy herd. So as long as we've got the cow numbers there, we're likely to, and the feed in the bunks, we're likely to milk cows, which is probably why quite a few folks said, I don't plan to change anything. I'm not going to cull cows. I'm not going to, tone the ration down. I've got what I need to make some milk, and I'm going to do it. If you look at the milk per cow per day, 2020 started off the year with a bang, pretty big increases in milk production per cow. But again, you can see one of the strategies that people followed was obviously to tone down the ration, because even though we culled cows, and you would expect that they were not the top producing cows in the herd, you might have expected production per cow to remain strong, but it didn't. It dropped. So part of the strategy followed before was to have a less dense energy ration, and milk per cow dropped in May. It's now back in pretty strong territory again in October's numbers. So we have both big number of cows in the herd, and we've got strong milk production per cow. If you look around the map of the country, you can see that we've had growth in more states than not. Now, we only have the first 3 quarters on a full state-by-state basis to report on. So I'm comparing the first 3 quarters in 2020 versus those same quarters in 2019. Kind of that central part of the country from Texas on up to South Dakota was where we saw the biggest increases on a percentage basis, but plenty of other states like Illinois, Indiana, Michigan, Pennsylvania, New York, all had increases in milk production, as did California and Idaho. So it's probably easier to look at the states that actually declined in milk production. It's not just the U.S. The red line in here is showing you the percent change in U.S. milk production, but I'm also showing you in that gray line the milk production from all of the major exporting countries of the world. In some sense, not only the U.S. in that gray line, but also our competitors, meaning European Union, Oceania, and Argentina in that line. You'll notice back there in May that we had this dip seen right here in the U.S. production numbers, but the whole world dipped at the same time. They had some of the same experiences we did. But while we've come back, so has the rest of the world. So there's been pretty big increase in world milk production, not just in the U.S. We're bigger than most of the rest of the world, though. So we're getting a lot of milk available to the rest of the world. We need worldwide demand to hang tight if we're going to continue to sell a lot of dairy product into export markets. What about optimism or pessimism? This is looking at the January 2021 CME contract over time for both Class 3 and Class 4. You'll note that Class 4 has been trending downward or remaining flat for most of this time period. Optimism there hasn't changed much because it's pretty much what do we expect those world prices for powder to be. That's what's clearing markets for Class 4. And in Class 3, we've had the opportunity to go from a $16 expected price for January milk to well north of $18. But we've also had more pessimism as we look at potential demand, and the production of milk coming on brought us back down around $16. And here we've been fluctuating up and down over the last month or so. So we aren't really sure whether we're optimistic or pessimistic about prices in general. Here are my forecast factors. This is what we have optimism about. We've got a new Foodbox program. That's the 5th round of these things. There's $1.5 billion that will be spent on this Foodbox program. Dairy is going to be a part of that. Initially, we had just cheese and fluid milk in that program and only certain kinds of cheese. It's been expanded to a variety of dairy products, so we can have specialty cheeses in there now, and we can have sour cream or cream cheese or other things in the Foodbox program. So we can perhaps move some more products or different products, dairy products in the Foodbox program. Grocery store sales have still remained above year earlier levels, but the heady growth in that is slowing down a little bit. People, I think, are getting ready to get out and either eat out of our homes or at least pick up the food and bring it back home. But home cooking is still a thing, and we're doing more of it than we did before. Restaurants and schools have been struggling, tried to figure out how to reopen and remain that way, but we're starting to move a bit more through those channels as well. And we've got some back to work that's happening. There is some version of normal. We hope that we don't have to fall back into some new round of safer at home, much like the UK has had to do with the new variant of COVID that they've been experiencing. We do have an additional export opportunities, and look, with new COVID vaccines, better testing, better contact tracing, all those things I think give us some optimism about dairy markets this next year. But we still have real concerns about how rapidly that vaccine is going to be administered. It's going to take time before we achieve herd immunity and get back to what looks like we remember in previous years. And even when we do, the US is going to take a while to dig out from this recession, as is much of the rest of the world. This is not going to be an easy thing for us to climb out of, and I don't think that, by the time we get to late spring or early summer, we're going to say, life's all good again, everything's fine. It'll take us a while to dig out from it. We've also got some new cheese capacity coming on. Michigan, for example, has this large new plant in the center part of the state that is open now, and it's not quite up to capacity, but boy, it's going to process between 6 and 8 million pounds of milk a day. We also have a couple plants in that I-29 corridor that have added capacity, and in Wisconsin. Collectively, just those 4 plants that I mentioned there can process quite a bit more milk. That's good. I mean, it can mean that we aren't going to be dumping milk. We've got a home for it this time around. But I think it also is likely to mean that that additional cheese on the markets are going to have to find a home to clear those markets. And will that be closer to world market prices? I'm thinking actually that it will need to be closer to those world market prices. We'll have less opportunity to have our domestic markets be the thing really driving those cheese prices all the time. And with that, I'm at my next poll question, Mike.
Very good. Well, get ready to vote, folks. Here we go. Would you rather produce more milk at a more stable export price, or accept the volatility at somewhat higher milk price opportunities? So you have 3 choices here. So that should speed up the voting. Number 1, first choice, I like higher prices and we'll take the volatility. Choice number 2, the extreme volatility makes it hard to run my business. If you're a farmer, a processor, nutritionist, consultant, veterinarian, or number 3, no strong feelings about volatility at this point. So the polls are open and the votes are coming in right now, and we're at about 40%. So it looks like there's no filibustering going on by the Democrats or Republicans at this point. Mark, Abby, what would your vote be if you're voting for the Hordes farm?
Yeah, I mean, it seems like volatility is kind of the name of the game when you're a farmer, especially a dairy farmer. In talking and hearing from farms that do a lot of price risk management, it really seems that being able to secure, a break-even price or a price that covers your costs is more important than perhaps capturing the highest price, even though it is hard to see those milk prices go up when you have a price locked in. But I would say the second choice is, probably I guess, how it would feel, and if you're trying to really prevent those highs and lows.
Okay, Jim, let's go ahead and share that. And Mark, what do you think of the survey results? We had about 60% of the people responding, which is a couple hundred people.
I'm a little surprised, honestly. I think in years past, if we would have had the same polling question, I'm betting that this would have been just about flipped between answer 1 and answer 2. That folks would have said, give me the high prices, I'll take them. I can handle the volatility. But boy, we've had such extreme volatility and low lows that, a lot of folks are having trouble cash flowing through some of these stretches. And I'm surprised that 70% of people are saying the volatility is tough. I would like something to help me deal with that a little bit better. So I'm surprised at this, but I think that's an interesting result, and I'm glad people have shared. So let's get back and see what we can do. Are we back at the polling now? Yes. All right, on to the next question. Here's my price forecast. Well, first of all, let's take a look in those solid portion of the lines. We can see where our class prices have been. Blue line is class 3. Goodness sakes, we hit, $24.50 a hundredweight in July, and well above $23 here in October. So we've had a lot of peaks, but we've had troughs as well. Class 3 below 13 in May, and a decline, back around that $17 range at this point in time. Class 4, as I said, has been a bit more stable. Again, that's more dependent on these world markets and us being competitive there all the time. It doesn't mean there hasn't been volatility, but it's more stable at a lower level. So these are my price forecast in those dotted lines going on out. I am forecasting a more stable, something like a $18.50 price for U.S. all milk price. But I will tell you that that stability that you're seeing there has as much to do with, I'm not really sure I know, so I'm taking a guess it's somewhere in the middle of the road, as opposed to, I see nothing but tranquil waters in front of us. That's not what that stability means. I think we're going to have some more tightness in the marketplace during some periods of time, and I think we're going to see some time periods when our markets are challenged again. I do not expect the kind of troughs that we saw in April and May, in no small part because we've been through that now, and I think the markets better know how to handle if we even have to have another shutdown, of home marketplaces. So that's where my forecast comes in. Now, let's just go back and take a review. That column all the way over on the right is the forecast for the rest of 2020, and that's showing you about an $18.24 U.S. all milk price on average. If you bought DMC, the dairy margin coverage, at the 950 level, we will have averaged something like 67 cents a hundredweight across all milk production that was covered at that 950 level for the year. And on top of that, I've got a green cap, and those are showing you the average payments from the CFAP program directly to dairy producers, about $2.45. And that's a significant payment. We're looking at some of our early returns on finances that have come in on farms, but honestly, when we look at this, it's not nearly as bad as we thought it was going to be. And in fact, there are going to be some farms that are going to have to think a little bit about tax implications this year. So this was not a bad year. And in fact, if you look at the total income, and here I'm not saying milk price, I'm saying net milk income, because you don't get the DMC payments or the CFAT payments unless you're producing that milk. At 21.36 as kind of a U.S. all milk price average with the extra payments in there, we haven't seen that level of milk price since 2014. So this is the best year we've seen in several. And it's had an impact. This slide is just showing you, because we don't have it monthly for all states, but Wisconsin does post licensed dairy farms on a month-by-month basis. And this is the attrition rate, the percentage of farms that we're losing. So for example, if I focus on that orange line, that was 2019. We started off the year in January with losing about 8% of our dairy farms. But by the time we got to December of that year, the orange line clear on the right-hand side, we were losing more than 10% of our farms. So increasing farm loss through 2017, 18, and 19. Finally, in 2020, that farm loss has begun to slow down. We're still losing farms, but not at the same rapid rate. And actually, the first month of January is below 5% loss of dairy farms for Wisconsin. So the better income has helped farms, I think, this year as well. And I'm hopeful that we see the same thing in our national numbers as we do in the state of Wisconsin. Forecasting ahead, dairy margin coverage. If I use the U.S. all milk prices that I was showing you, and we look at the higher feed costs, Mike, from the corn and soybean prices that we're seeing in the year ahead, we're expecting DMC payments for sure. And the margin here in the dashed line is the forecast. You'll also notice that about from the top of that yellow bar in there is close to the 950 level. We're expecting payments for most of 2021 at this point in time. So I hope that people have signed up and that all of the tier 1 that you have available to you, you signed up for at the 950 level, because I'm expecting that this is going to be another year when we have some pretty big payments under the DMC program. In fact, you can look at the probability of covering those premiums. I know it costs you 15 cents to cover a 950 on the tier 1, but there's almost a 100% certainty that you get that 15 cents back and more in this coming year, the 2021 year. Tier 2 is just too expensive, but tier 1 could see payments at a lot of different levels of coverage with pretty high probability. Have you managed your risk? I think that the dairy margin coverage is a no-brainer. And, you know, honestly, I seldom make recommendations like this, but since that program was changed, I just think that it's a smart thing to sign up all year or tier 1 value that you can at the 950 level. There is a change in this new pandemic stimulus bill that was passed that we don't have all the rules for yet, but I think we know pretty much what's going to happen. And that is, if you've had an increase in your historic production, that farms will be able to capture more of that, up to 5 million pounds. So just for example, if you had a 2 million pound historic production and you've now increased to about 4 million pounds, you'll be able to capture, I think, 75% of that additional 2 million pounds to add to your historic base. So that will be a good thing going forward for all farms that have production in that range. For milk beyond that level, you need to watch for opportunities in the futures markets. Those price opinions move around a lot, and in fact, they've moved around quite a bit just the last week or two. Look for your opportunities out there. With programs like dairy revenue protection, you're going to have to look at that at least a quarter out. And so you've got to have a pretty strong movement in the futures market that's sustained for several months ahead before you're going to find opportunities you might want, but look for them. If they're there, put a floor under some of those prices. If you see an opportunity that's really jumped up because of short-term buying with Foodbox programs, for example, You probably can't capture that with revenue protection, dairy revenue protection, because it's got to be at least a quarter out. But you can do that with something like options in the futures markets to capture some of those nearby futures prices. We may have some of those opportunities. If we do, put a floor under some of your milk if you are just not able to handle this risk on your own. I finally said I was going to talk briefly about PPDs. Given the fact that we've had some buoyancy in our marketplaces out here, this is just order 30. You can see that I'm still forecasting negative PPDs, but not nearly as bad for 2021, especially in January time period. During that time period, right now with the current futures markets, it's suggesting we would have a negative PPD. And if we get a fair amount of depooling, it will be even more negative over there. Could be up to $3 or $4 negative PPD in January. But after that, it starts to dwindle and we may not see much of a negative PPD at all. So negative PPDs, I think, are still in the future, and that's mostly going to be because of the big difference between class 3 and 4. Occasionally, it's because of a rapid expected increase in the class 3 price. So, polling question, Mike.
Yes, we have our last polling question. So here's your last chance to vote, and the polls are open. PPDs have been an issue for much of 2020. What would you like to see done? And again, 3 choices. First, PPDs are a major problem with federal orders. Fix them ASAP, immediately. Number 2, if component values are high enough, I really don't care about PPDs. And then the third choice is there are multiple problems with the federal milk marketing orders that need to be fixed. So we're voting, and we are much slower here on the vote. I tell you, people are thinking here pretty hard with 3 choices. Good thing, Mark, even more. Abby, your thoughts on this?
I know that PPDs have certainly been an area of financial stress and conversation this year, so be curious to see where people fall on this topic.
Well, we've got almost 50% of the votes are in here right now, and we'll give you another 5 seconds to wrap up here, and then we will share what they're telling to Mark. Let's go ahead and do that, Jim. Our time is tight, so we're going to share the results. Mark, what's your interpretation of the quick poll?
PPDs are clearly a problem. People are saying we need those fixed, but the thing that is dominating this is that most folks are saying that's only one problem with federal orders. There are a number that need to be fixed. So again, another interesting result that this could be a long-term issue for us to deal with. It's not just a PPD. We need to fix other things. So we'll have to be cognizant of that. Well, that's kind of taking me down to the end of my program, and I would be happy to take a question or two if we have them.
Very good. Thank you, Dr. Stephenson, for sharing with us your predictions for 2021. I know with all the unexpected twists and turns that 2020 took and the uncertainty that still lingers, that was no easy task to take on. So thank you for doing your best to predict what might be ahead for all of us in the dairy industry in the year ahead. Yes, if anyone has any questions, please type them into the questions section of the GoToWebinar control panel now. And in just a few moments, we will go through and answer those with Mark. Thank you. I want to once again thank our sponsor for this program, Cargill. We certainly appreciate their support of our educational offering here and thank them for joining us in this program today. And then if we look forward to our next presentations, our next monthly webinar will take place in February on the 8th. The title of that presentation will be Mind Over Matter When Something is the Matter. And here we'll be focusing on mental health and the stress that comes with farming and how you can help yourself and others deal with the obstacles that come with the profession. Our presenters will be Amanda Stone from Mississippi State University and Larry Trainell from Iowa State University Extension. Then in March on the 8th, we'll have a presentation by Jim Davenport, who is a New York dairy farmer and a multiple-time winner in the NMC National Mastitis Council Milk Quality Award. So he will be joining us to talk about what they do to maintain high milk quality on their New York dairy herd. So please mark your calendar and make plans to attend one or both of those presentations if you can. Today's presentation and all of our past webinars are available online on our archive. Just visit the Horde's website. Today's presentation will be put up in a couple of days. So if you would like to watch again or share it with anyone else, you can find it there. Now, Mike, we did have some questions that came in during the presentation, and it looks like the list is growing quickly. So if you would go through those, and we will have Mark give his best answers to those questions.
Well, thank you very much, Abby. We do have some excellent questions here. Mark, here we go, and it's kind of like the speed round. Is there any, what is your thoughts on how the next Foodbox program will impact dairy producers, milk prices, when it starts to happen?
Good question. In the past, we can't tell exactly how much money was spent in each of those food boxes for dairy products, but we have some good estimates. I'm thinking that it will be between 25 and 30% of the total allocation for food boxes. So it could be in the $400 million to $500 million range, something like that, to buy dairy products. That's a substantial amount of dairy products. It will have an impact. Certainly will help tighten up our 3% growth in milk production.
But is that a long-term or short-term
that's short-term, Mike. Yeah,
okay.
That's short-term impact. That's right. It will happen. It will go over a 3-month time period. And, then that food box spending is done. The real question, I suppose, is do we expect that we'll have any more food boxes, or, not that we won't have food insecurity, but will it be handled differently in the new administration?
Here's another question I think, Mark, came from one of our producers, and that is, as a farmer, having to create balance sheets and to deal with bankers, is more stability better when you're facing that kind of situation?
It depends a little bit. From a banker's standpoint, less risk is better. That means that your cash flow projections are likely to be met, and we don't have any big surprises. But from the standpoint of a producer, it gets down to be a little bit more about what is it that I personally like. Can I sleep at night? When these prices are banging around. We know that there is a risk-reward trade-off. So if I'm willing to handle or to take that risk and handle it on my own, I will make more money. It costs something to have risk protection. So I think that I don't want to lose my business. So if I can't handle the risk, then I'd better do something to make sure I'm protected from it.
Okay, another interesting comment. This individual says depooling is a bigger problem than PPDs. Do you agree or disagree?
PPDs are just an accounting process. So it just meant that we paid more out in component values than we collected in the pool. And, so a PPD value by itself is not really telling you too much of anything. But what it does is it provides a disincentive for class 3 plants to stay in the pool. Now, if they get out of the pool, there is no regulation for what they have to pay for minimum prices on milk. They can pay whatever they need to get milk into the door of the plant. And from what I've seen on milk checks, I would say that most of the plants that have been paying under depooled milk have treated producers fairly. They've kind of split the difference. So they kept some of it. They paid a lot of it back out to their dairy farmers. They didn't necessarily pay a full class 3 price, but they paid more than the blend price or uniform price was, and they shared that with dairy farmers.
So your comment is interesting. They get to keep part of that. In other words, if they share with the farmer, does the processor gets to keep whatever they didn't share when they depool?
In some sense, yes, they do. What the PPD is actually telling you is if I'm a class 3 plant, let's say, and we've got let's just give you a real quick example. Let's say that the uniform price was $18. that would be what I need to pay my producers, at least $18, and then any premiums on top of that. If the PPD is on top of that, a negative $4 as a class 3 plan, that means that I also need to kick $4 into the pool. I had to pay my farmers 18 bucks. I had to put $4 into the pool. That means that other processors get to take a draw from that $4 to help pay their dairy farmers $18 a hundredweight. I want to not pay dairy farmers that aren't my own. So that's why I would depool and pay my farmers maybe $19, maybe even $20. But I'm going to keep some of that money for myself too.
Very helpful. Here's another question. You mentioned that we're up over 3% milk. Do you think processors will institute another base excess plan in the future? Any feeling about that?
Well, that would be cooperatives that would implement a base excess plan. A dairy processor, if you sell directly to them, can only say, I only want this much milk. In other words, I'll only take 90% of your milk production. You have to deal with the rest of it, and which probably means you'll cull or dry cows off early or whatever you needed to. But if we get into any kind of rapid decline in, let's say, post Foodbox, and if we've got still big milk production, we may have to do something to implement controls again. Not sure about it, but I at least want to give you the heads up. It's not out of the realm of question.
Mark, do you have a feel? Are there any controls in line now, or have they all kind of gone away since September, October? I don't have a good feel for that. Have you heard anything at this point, or what's happening in terms of from the previous May and June?
I'm not aware of any of those programs that are still in place, but the structure is there. So we could implement them again. We could say that, don't just sell me all the milk you can, that, I will only pay full amount for your base level, and, it will be a reduced amount for any milk above that. And, that's the thing I think could happen again. I'm not aware of any that are on right now, but I'd be getting a little bit nervous about it, honestly, that it may be implemented again.
Another question came in, and that is, what is included in the all milk price, as you mentioned?
That is a different price. That is simply kind of asking the question of processors, what did you have to pay to get milk in the door of your plant? That includes paying not for 3.5% butterfat, which is what the standard test is on federal order milk, but that's milk at test. So all the components. It's also all the premiums that you've paid above that. So it's whatever you had to pay in terms of a total dollar amount to get milk into the door of your plant.
Okay, another interesting question. How do you see the new administration working with dairy, especially with Mr. Vilsack, who used to be heavily involved in dairy, now the new Secretary of Ag?
I think the dairy is going to be treated in a friendly kind of way. I don't necessarily think that means we're going to get, undue attention, but Mr. Vilsack obviously had understanding and care about the dairy industry before he accepted that position with USDEC prior to this. And I think he's come away with that with some pretty good ideas about trade and what trade for dairy could look like or should look like. So I think dairy is going to be treated fairly under here. But I also think that he is an agricultural secretary, and with previous history knows a lot about what it takes to run a broad-based program, not just dairy.
Another question is, given the state of Washington, D.C., is there any reason to believe that the federal order reform has any chance of happening in the next several years?
If they announced next month that we're going to have a federal order hearing, and it was going to be a broad-based hearing, as folks here were indicating, we got a bunch of issues that need to be looked at, not just negative PPDs. It will take years for that hearing to take place, to hear everything that needs to be heard, to have the Agricultural Marketing Service go back into a huddle and come out with a recommended decision before we vote on it. It's not going to be a short-term process. There are a few things we could probably do quickly, but I'm also afraid that just addressing one small piece of a federal order system is only going to cause additional problems in other areas. I think we have to look at it as an entire system of regulation and rules.
Okay, boy, they're coming in fast. Do you believe that the food box program drives Class 3 milk markets artificially and sends message to producers to expand? In other words, keep those cull cows, low producing cows. Do you think that's realistic that producers can reduce production with a potential base plan? And maybe you covered that a little bit already, but Mark, your thoughts on that question?
Oh, we certainly reduced milk production as a result of those base excess plans. So yes, those did work. And I forgot the first part of your question there, Mike. Can you give me a quick refresh?
Yes. Basically, is it an artificial? You know, is it just and therefore causes people to say, "Oh, look at the food box program is now generating more income. I'm gonna milk more cows because I think the milk price, at least short term, is going to be favorable."
To some extent, it is. Especially the first of the food box programs were requiring fairly fresh cheddar cheese, and we had people out looking for sources of that. That's the kind of product that is traded on the Chicago Mercantile Exchange, the CME, you know, block and barrel prices there. Those got impacted rapidly, and that is picked up as a benchmark price for pricing lots of cheese product in the US, which, you know, is certainly going to fall into that weekly survey of cheddar cheese prices for the AMS, which gets reflected in our Class 3. So yes, food box programs do impact our cheese markets and milk prices.
Well, here's another related question. If we can fulfill the U.S., Canadian, Mexican agreement, what impact would that have on dairy farmers' bottom line in a positive way? Or what's your view of that?
It will have a positive impact. I think that it will be relatively modest. We will sell some more product to Canada, and you know, we should count our blessings for that new opportunity there, but it's not a lot. It's not enough to really move the needle a long way. Mexico has been a great market for us. We were at free trade before the USMCA, and we kind of fought our way back to that again under USMCA. So it's good. But I think that, you know, it's not like the really great thing. We're going to have to look at other markets for the substantial sales of exports, not just our nearby markets.
Well, very good. Abby, I think that completes all the questions we need to answer for today. I'll turn the program back to you to wrap up.
Thank you, Mike. And thank you, Mark, very much for taking the time to join us for this presentation and then answering all the questions that came in. Again, we always appreciate when you join us on these monthly webinars and also your participation on our dairy live stream webcast as well. So thank you very much for that. I want to give a final thank you to Cargill for their support of our program. Once again, we thank them for being a part of our webinar series. And then, as always, I want to thank all of you in the audience for taking the time to be here with us today. We appreciate you blocking off this time during your busy schedules, and we hope that you're able to put some of this information to use on your dairy farm or with the dairy producers that you work with in your daily tasks. If any of you are interested in our upcoming topics, once again, in February, we have the Mind Over Matter, when something is the matter, as our presentation. And then in March, we'll be talking about clean cows, making clean milk. So please mark your calendars and make plans to join us for one of those webinars. Once again, thank you for participating today in our webinar, and we hope to see you on a future webcast. Until next time, I'll say goodbye from all of us here at Hoard's Dairyman and our team at the University of Illinois.